the Australian dollar jumps after the jobs numbers come out. That's the knee-jerk reaction. We see an unemployment rate of 5.4%, Carson, for October.
Yeah, we've added 10,700 jobs, and so that's slightly more than CommBank were forecasting. CommSec actually, they did believe would see 10,000. Interesting where the part rates fell.
Yeah.
That was actually a little softer than Reuters' expectation. 65.1, 65.2 was the expectation.
And maybe that prevents the jobless rate jumping up a bit more. So it is at 5.4%. We thought it would jump up to 5.5%, but there has been a lower than expected participation rate at 65.1. Full-time employment, we added almost another 19,000 jobs, so that's a pretty impressive split in terms of the full-time, part-time. And as Carson said, overall, almost 11,000 jobs being added to the economy. So on most fronts, better than expected, I think, on a couple of those levels today.
Fewer hours worked, down 4.2 million. Let's put all of that into some kind of context for you. Bring in our panel of experts. We've got in studio Simon Bolden from Aqualis, and then not far away, Fred van der Tang from Randstad. And indeed, let's take you to Melbourne. First off with Cameron and Judson. No, we won't. So we'll go with Fred. Stick with you, Fred. What's your instant takeout on that one, particularly the build and full-time work?
I'm sorry, you're asking me?
Yeah, absolutely.
Oh, hi, sorry, I couldn't hear well.
Yeah.
Yeah, to be honest, I'm taken by a little bit of surprise by these numbers. It doesn't really correspond to what we're seeing. Actually, what we're seeing, and I think it's interesting to see that both participation are down, but also the number of hours worked are down. What we're seeing, there's definitely a lot of pressure on the employer side to boost productivity in a relatively tight market. We're seeing that hiring confidence, if anything, has gone down over the last months, particularly in some sectors. So I'm a little bit puzzled about the increase in full-time jobs, to be honest. I expected the opposite.
So does it suggest a slowdown in business to you to see the hours down, Fred?
I'm sorry, I have a bit of trouble hearing that.
Apologies. Fred, just in terms of understanding why you can get, or what it's reflecting, the fact that you've seen a drop in the hours worked, what would you say that's actually reflecting about the economy and about even the sentiment amongst employers at the moment?
Yeah, what we're seeing is that some of the core markets are actually down. I think one of the biggest turnarounds over the last months has been in mining. Mining, of course, and resources have had huge job creation. And what we're seeing is that some employers have really stopped hiring, at least in terms of growth, and postponing projects as well. Instead, they're trying to get the maximum out of their current workforce, and that means that they're playing with the numbers of hours worked as well. We're seeing less overtime, more people sticking to the scheduled working hours as well. Really in an attempt to increase productivity to still boost the bottom lines.
Let's bring in Cameron Judson from Chandler, Macleod in our Melbourne studio. Cameron, hearing all of that, it's kind of consistent from the Reserve Bank's perspective earlier this week, believing that labour cost inflation would not be an issue for this economy. Is that what you're seeing? A bit of a reality check on the environment we're in and job seekers tempering their expectations?
Yes, Carson. We're seeing in the market caution on behalf of employers, both in terms of permanent hiring intentions, but also, to the earlier comment, a real focus on productivity and efficiency. And in that market, I think candidates are in the market in anticipation, looking for work, but in all likelihood going to find work after Christmas.
Right, Simon Bottoms, to you on that score. If you sit tight and wait till after Christmas, anecdotally, particularly in areas like finance, higher paid roles are being scrapped in favour of getting somebody in for a lot less. Is that a theme we can expect to see roll through the early part of next year? How much longer has that one got to run?
Carson, I think that the senior end is probably where the squeeze is being most felt, certainly in the finance sector, like you said.
You define senior by how much? What's the band we're talking?
I guess we're talking here about the sort of director levels, jobs that above the sort of, 150 and above. So this is where organisations will be adding significant numbers to the bottom line. And this is often as well where organisations have been running quite fat. You know, as they've been busy, they've had to have lots of leaders for lots of people, and with less people now, you know, those people really aren't required, and so a lot of people are finding themselves in redundancies, out on the job market at that sort of more senior level.
Does that imply, just as a follow-up, that when you say redundancy, the role will not be filled into the future? I mean, that's normally got to be the justification. You make someone redundant, you close off that role. How do you then bring in somebody when the business picks up?
Well, it's not necessarily hiring externally to replace these people.
Right.
I think there are organisations with the capacity to have people already there actually do the job as well.
Okay.
So people are finding that their jobs are, and this I think reflects in the participation rate, organisations are doing more with less.
Okay.
So with these headcounts reducing, with headcounts freezing, I think the expectations are still there, the workload's still there.
Yeah,
people are working harder.
Cameron, in Melbourne, just dealing with that headcount issue, what do you think on that?
I think employers are pulling the obvious levers in the lead up to Christmas. They're being very cautious about hiring intentions. They're pulling the annual leave lever. I think equally they are looking to extract return in terms of productivity and efficiency. That's probably sustainable in the short to medium term, but as businesses seek to grow, they'll be looking to invest in talent, whether they be existing or new talent, to grow their businesses.
Yeah, Fred van der Tank from Randstad, back on you. We've got more people entering the workforce with a growing population. How is that showing through in today's numbers?
In terms of the greying population, you said, Carson?
Correct.
Well, look, I think the availability of the greying population in terms of an extra and experienced part of the labour market is an interesting phenomenon, and we've seen quite a shift from employers in terms of their interest to employ people with higher experience, helping out the younger ones in terms of upskilling and training as well. At the same time, it requires more flexibility from the greyer population as well, in terms of both mobility and being flexible about the kind of jobs they take on as well.
Yeah, and that is the story that's playing out. But what about from greying to growing? The actual theme of more people coming to the market, whether it's a boost in immigration on the numbers we know, is actually the case for this economy.
Yeah, we're not seeing that the growth would be created by more people from the grey population getting into the labour market. In my view, it would be more boosted by immigration, meaning people from Asia and other places from overseas.
You want to add to that, Simon, in
Yeah,
studio?
I think that the other thing is the other side of the picture here, which is people moving from Australia as a tight labour market into Asia jobs, where I think the demand is still high, despite the election sort of impacts on the other markets. I think Singapore and Hong Kong job markets are going to remain strong. So there are Australians that are taking...
Have they come off, though?
They've certainly come off from the sky highs that they were over the last few years. But that said, it still is an attractive proposition for some Australian workers where the labour market's tight here.
Yeah, Cameron Judson from Chandler Macleod.
We're seeing in Hong Kong and Singapore subdued hiring intentions. Again, maybe that's our experience in terms of the markets we serve, principally banking, finance, back office, IT. I think the point being made, though, is valid. I think as businesses look to how they grow their organisations post the productivity and efficiency play, that's all about talent. So if you're in a position where you can identify talent, that talent can add to your competitive advantage or grow your revenue base, people are still confident about hiring.
Just want to bring that back to the Australian story, Simon, because if it is the case that we could be in store for about another 10,000 finance jobs to go inside the next couple of years for this market, where are we seeing this build of 18,500 jobs that we've registered today, full-time jobs?
I still think, despite the mining slowdown, there's people that are being brought onto existing projects as they develop. Some sectors are still busy. We're doing a lot of work in the PPP infrastructure space, and if you look at New South Wales requirements on infrastructure, that's going to generate jobs as well. So I think there are sort of pockets, Carson, where there is hiring. There has to be hiring. 7
months, though, of an ANZ lead indicator job series that's going backwards. So is there a link with today, or are we seeing a gulf widening between that data and the trend in this?
No, I think that that job data sometimes has its skews with multiple jobs being advertised, different roles being advertised in different ways, and jobs being advertised longer than they're actually filled.
Right.
So it's all sorts of
gremlins of the system.
Yeah, exactly right. But I think that going back to your question directly, there's still this movement of people offshore, and organisations are still looking at cutting those employment costs by using cheaper locations. Australia is now an expensive place to do business. Yeah. We get taxed high. The employment salaries are high comparative to the US and to Europe. So I think with that expense not being made any easier by the government, it will mean that organisations will, if not move things, certainly look at putting skills offshore.
Just while Simon Bolton's speaking there, you've got the Australian dollar reflected on screen. It's taken quite a jump after those numbers. It just doesn't look like that a 5.4% unemployment rate is a trigger for a rate cut in December. I think that seems to be what the market's suggesting when we look at the reaction to that. Christopher Joy on Twitter saying basically that. Also Adam Carr, we had him with us in studio a little bit earlier in the week, talking about the actual interest rate decision. He said that they should hold, and he says the alarmism over the labour market is overdone. Unemployment rate 5.4%. That's inconsistent with the emergency rate settings back in 2008 that we've been talking about this week of 3%. So he's not seeing any more need for rate cuts. Fred Vandertang from Randstad, this is the funny thing, because when Carson and I speak to a lot of the groups representing business, it's this eternal call, rate cut, rate cut, rate cut, we want more. And yet, you know, just give us an idea of what you're seeing in terms of reaction by business to the rate cuts that we've had. And, you know, if there's no more to come, does that make a difference, or does it basically go back to what Simon's saying, the high cost of doing business in Australia still very much front of mind?
I think a lot of this has to do with looking for more confidence, and also availability of funding and finance and capital in many businesses. Some of their core markets are not growing at the moment, so what they're doing instead is scraping for market share as well as productivity on the inside. So interestingly, we are seeing still pretty strong job creation on the side of sales roles and account management roles. So those of the people on the labour market that have talents in that area can still be secured of a good future. So businesses are doing both, as I said, scraping for some market share and making sure they tighten their belts as well. They are calling for this rate reduction. I'm not sure personally if that would be a panacea for all of this, and I'm still getting some confusing signs here, because again, what I said, what we're seeing in terms of slower hiring intentions from our clients pretty much across the board, with a few exceptions. I was thinking as well, by the way, the whole healthcare sector is still creating pretty big amounts of jobs, so that may be still one of the less talked about sectors as well, but it still remains a confusing picture compared to what we see today and what we're seeing every day talking to our clients.
Yeah, let's just go back to Melbourne. Cameron Judson from Chandler Macleod. Just in terms of cost controls, that's been a story for finance. Where else is it likely to take hold to other sectors where we could see a squeeze, if not in today's numbers, certainly into next year?
We're seeing that in our own experience in the mining sector, where the pressure on the commodity price and the high Australian dollar is leading to the miners to look aggressively at how they drive productivity and efficiency as margins are under pressure. We're also seeing that in state governments on the eastern seaboard, where they're looking to strip out waste and lift productivity across their workforces. So I think that's in the public domain. I think the other sectors that are well known under margin pressure are transport, logistics and manufacturing. And I think Frank's earlier point is also sanguine, though. I think there is investment and growth in sales, account management, because people are looking at how they grow out through this cycle on the other side. And I think we're also seeing the same growth in the healthcare space. Simon,
back on you. We just have to face this one month after month, the call that goes out before the numbers and then what we get back. There is something rotten about the data collection from either a pre-release perspective and what people say they are hearing. When we are told that there would be a build of 500 jobs and we get a rise of 10,700, how can we just explain that away and just look the other way month on month?
Look, I think there has to be something in the collation of these figures that probably needs to be looked at. The numbers seem to be, as you say, Carson, all over the place. Once they're here, expectations here, it comes out there. But they're also quite short-term measures. So I think we've got to look at the longer trend that's involved. There's no doubt the job market's under pressure. Organisations are under pressure. Headcount's one of the key levers that organisations can pull. So that's not going to change whether it goes up 0.1, 0.2. We're under pressure. Costs are under pressure. Jobs are one of the things that are in focus, and that's the way it's looking like it's going to be for some time.
And we're mobile, so the other option is jump on a jet plane and look elsewhere, as you've said today.
Certainly for some people, that will be an option. I think there's still people coming the other way. I was talking to a client only this week who's up stumps, is now here in Australia with the family, looking for a job, and it's going to be hard for him.
What got him and his family over here? What was the draw?
The poor state of things in Europe.
All right.
I think also...
So we've still got that.
Well, there is this notion that the streets are paved with gold in Sydney, and I think that reality sometimes isn't necessarily reflected. So I think there is still that draw card of people coming to Australia, sometimes with false ideas that it is all easy here, all good.
Well, maybe in relative terms it is a little bit easy here. Fred Vandertang from Randstad in our Sydney studio. Just some final thoughts from you as we close off. And maybe on that question of just why these numbers just never seem to reflect the conversation we have with you guys, who are really at the coalface.
Yeah, that's right. Look, I think businesses don't need labour market statistics to make up their mind in terms of their investment decisions and their hiring decisions. They know exactly what their pipeline, their order portfolio, their P&L looks like. They're astute and they know what to do. We've got our foot firmly on the ground and talking to those businesses and talking to the labour market every time. I expect that we're going to see a few months with subdued hiring. We hope, of course, for lots of reasons, that come February, March, hiring intentions will go up. So it's going to be interesting to follow the results and trends over the next months.
All right, let's wrap it there. I want to thank you all. To you, Mr. Van der Tang from Randstad, Fred Van der Tang. We've had also remotely from our Melbourne studio, Cameron Judson from Chandler, Macleod, and sitting with us on set, as is custom, Simon Boulder from Macleod. Let's appreciate it. All right. Dollar pops, and that was of note.
Yeah, dollar pops. And actually, the Australian share market hits its highs of the day. Having said that, it's still down 0.8% because it was a whole lot worse than that. So intraday high for the market. The Australian dollar actually takes a leg up on what some have described as robust numbers on the headline, but others, of course, who were talking about rate cuts, and if that's part of their forecast, they're using the numbers today to point to the hours down, the participation weaker, and the fact that really there's actually been no new jobs net since May, according to Stephen Koukoulas. Yeah. But I think there's something for everyone in that set of numbers today, so we'll watch that play out through the day. But I think the market reaction is pretty obvious.
All right, there's plenty more on the other side of the break. Don't go anywhere. We're back in just a minute.